Good evening, I'm Atlas Morgan, and tonight we're breaking down one of the most extraordinary financial phenomena of our time. Gold, silver, and platinum have all surged to record highs, with gains not seen in decades. This isn't speculation. This is data. And the data tells a story of central banks hedging against the dollar, supply chains breaking under pressure, and geopolitical chaos driving investors toward the oldest safe haven in human history. Let's start with the headline numbers. Gold is trading just below $4,500 per ounce tonight, up 71% this year. That makes 2025 gold's best year since 1979, when Jimmy Carter was in the White House and inflation was ravaging the American economy. To put this in perspective, gold started the year at around $26.40 per ounce. It has nearly doubled. Silver has done even better, topping $75 per ounce for the first time in history, a gain of 140% this year. And platinum, the dark horse of precious metals, has surged 160% to $23.50 per ounce, its largest annual advance since at least 1987. The question isn't whether precious metals are rallying. The question is why, and whether this is just the beginning. The first driver is monetary policy. On December 10th, the Federal Reserve cut interest rates for the third consecutive time, lowering the benchmark rate by a quarter point to 3.5 to 3.75%. For precious metals, rate cuts are rocket fuel. Unlike bonds, gold and silver don't pay interest. When the Fed cuts rates, bond yields fall, making non-yielding assets like gold more attractive. But here's where it gets interesting. The December decision was marked by a 9-3 vote, the first split of that magnitude since 2019. The Fed's projections now suggest only one additional quarter-point cut for all of 2026. Markets are reading this as hawkish, but Goldman Sachs still projects gold reaching $4,900 by the end of 2026, while J.P. Morgan forecasts gold averaging over $5,000 per ounce by the fourth quarter of 2026. Some analysts see gold approaching $6,000 under certain scenarios. The second driver is central bank buying, and this is where the story gets geopolitical. Central banks around the world have purchased over 1,000 tons of gold annually for 3 consecutive years. That's double the historical average of 400 to 500 tons per year. Global central bank gold holdings have reached nearly 36,200 tons, representing almost 20% of official reserves, up from 15% at the end of 2023. J.P. Morgan research identifies significant upside potential if countries with gold shares below 10% increase their holdings to that level. The buying is concentrated in Asia, particularly China, India, and Japan. According to Amundi research, this reflects, quote, the beginning of a gradual transition from a U.S.-centric international monetary system to a more multipolar one, end quote. The 2022 Russia-Ukraine conflict accelerated this trend when Western sanctions on Russian reserves demonstrated that dollar-based assets are vulnerable to geopolitical pressures. The third driver is geopolitical chaos, and there's no shortage of that tonight. The Trump administration has established what it calls a complete blockade of sanctioned Venezuelan oil tankers, with 15,000 troops and 11 warships in nearby waters. The U.S. has already seized multiple tankers, including the Skipper, a very large crude carrier now being escorted to Galveston, Texas. Venezuela called these actions, quote, serious acts of international piracy, end quote. But the implications go beyond Latin America. China buys about 76% of Venezuela's oil output. Seizures of vessels bound for Chinese markets risk escalating tensions between Washington and Beijing. Add to this the ongoing dispute over the Panama Canal, which Trump has threatened to, quote, take back, end quote, claiming Chinese influence over the waterway. As precious metals analyst Ahmad Asiri at Pepperstone Group put it, quote, geopolitical frictions have re-entered the narrative. These developments undoubtedly add to the background demand for gold as a must-have hedge, end quote. Now let's talk about silver, because what happened in October was nothing short of historic. The global silver market experienced an unprecedented short squeeze that sent prices soaring and exposed severe physical supply shortages. Under normal conditions, one-month silver lease rates hover around 0.3 to 0.5%. In October 2025, those same rates spiked to nearly 40%. At one point, borrowing silver overnight was costing 200% on an annualized basis. Traders were reportedly booking slots on transatlantic flights to physically transport silver bars from the United States to London. One market analyst noted, quote, "What isn't necessarily so visible to people is what's happening in the vaults. That had reached a point where there was basically no available metal left in London," end quote. Exchange inventories dropped from 290 million ounces at the start of 2024 to below 210 million ounces by October 2025. The silver market is now in its fifth consecutive year of supply deficit, with annual shortfalls exceeding 200 million ounces. The silver squeeze wasn't just a trading phenomenon. It reflects structural changes in demand. The photovoltaic industry, meaning solar panels, consumed record volumes of silver in 2025. Electronics and electric vehicle manufacturing continue to absorb increasing quantities. This is what economists call inelastic demand. Industrial buyers cannot meaningfully reduce their silver consumption without compromising product performance. Meanwhile, mining supply simply cannot keep pace. The Trump administration's Section 232 investigation into critical mineral imports added another layer of uncertainty. Although precious metals were officially exempted from tariffs in April 2025, traders remained concerned about potential policy reversals or new trade restrictions. This fear, combined with the physical shortage, created the conditions for the October squeeze that sent silver past $50 per ounce for the first time since the Hunt brothers tried to corner the market in 1980. Platinum's rally is perhaps the most surprising of all. The metal started the year below $1,000 per ounce and has now reached $2,350, a gain of 160% that dwarfs even silver's impressive run. This is platinum's largest annual advance since at least 1987. The metal recorded 10 consecutive winning sessions, its longest streak since 2017. Three factors are driving platinum's surge. First, automotive demand. The sector represents between 29 and 42% of total platinum demand over the past 5 years. Platinum is essential for catalytic converters in traditional vehicles and for hydrogen fuel cell technology in next-generation transportation. Automotive demand is forecast to rise 10% above historical averages. Second, investment demand. Bar and coin investment in platinum is expected to spike 47% year-over-year. Third, China's launch of platinum futures trading in November 2025 opened the metal to a massive new investor base. Over 600,000 ounces of platinum are now held in U.S. warehouses pending trade policy decisions. On the supply side, South African mining difficulties have created a third consecutive year of platinum deficit. Supply is forecast to decline 2% to 7.129 million ounces in 2025. When you combine surging demand with constrained supply, you get the conditions for exactly the kind of price explosion we've witnessed. Jewelry demand has also increased 7%, adding another source of consumption. The fundamental picture for platinum suggests this rally has structural support rather than being purely speculative. So where do we go from here? The consensus among major financial institutions is that precious metals have room to run. Goldman Sachs projects gold at $4,900 per ounce by the end of 2026, with upside risks noted. J.P. Morgan forecasts gold averaging over $5,000 per ounce by the fourth quarter of 2026 and potentially reaching $5,400 by the fourth quarter of 2027. Under certain diversification scenarios, J.P. Morgan suggests prices could approach $6,000. Amundi Research targets $4,200 by 2026 and $5,000 by 2028. For silver, structural tightness remains, quote, broadly intact, end quote, despite reaching uncharted territory. The gold-silver ratio, currently around 74.5, is down from its April peak above 105, suggesting silver may have further room to catch up. Platinum's fundamentals, combining automotive and hydrogen fuel cell demand with South African supply constraints, suggest the rally could continue. But these projections come with caveats. Central bank buying, while